On the surface, China is projecting some serious strength, right? Building new alliances, testing hypersonic missiles. But behind those glittering skylines, something just feels off. So today, we're going to dive deep into this paradox and try to figure out what's really going on with China's economy.
Okay, so get this. The official government line is that the economy is growing at around 5% a year. I mean, that's a number most Western countries would kill for. But that official story just completely clashes with what people are seeing on the ground. And this contradiction, it's right at the heart of what many are now calling China's silent recession.
So, first things first, let's forget the official statistics for a minute and just take a look at what's actually happening on the ground. If you were to walk through Shanghai's busiest districts right now, you'd feel it immediately. They're quiet, like eerily quiet. Shops that used to have lines stretching down the block are now totally empty. We're hearing that some of the biggest, most iconic office buildings have vacancy rates as high as 70%. And this isn't just a Shanghai thing. Landlords across all the major cities, Beijing, Shenzhen, Wuhan, they're all telling the exact same story.
This just begs the question, right? Why is China's massive economic engine suddenly sputtering out? Well, to get that, we have to look under the hood at the systemic flaws, the cracks that have been forming for years. And you don't have to take my word for it. Nobel-winning economist Daron Acemoglu puts it pretty bluntly. He argues that China's incredible growth didn't actually come from its famous top-down control. In fact, it was the opposite. It came from a period of limited economic freedom that has since been slammed into reverse.
For decades, the model was kind of simple. Let private companies do their thing with some limits and just watch the economy boom. But under Xi Jinping, that whole system has been turned on its head. Key industries, banking, they've all been yanked back under tight political control. And here's the crucial point. When politics overrides economic reality, innovation just freezes. Big mistakes get made, and no one dares to point them out.
A system like this, one that's all about top-down control, it's not just bad for growth. It becomes a machine that is incredibly effective at producing fake numbers on a truly massive scale.
Want a crazy example? Let's talk about population. The official number is 1.41 billion people, but there's some really compelling evidence that it's much, much lower. Back in 2022, there was a huge data breach from the Shanghai police, the country's national registry. It only contained records for about 970 million people. That, plus other data, suggests a potential shortfall of up to 400 million people. That's not a rounding error, that is a demographic time bomb.
So, how in the world do you hit a 5% growth target when your population is shrinking and no one's buying anything? Well, you engage in what some analysts are now calling GDP cosplay. To meet the government mandate, a province can literally build a bridge, tear it down, and then build it again. Boom, you've hit your GDP number. But is any of it real, sustainable growth? No way.
All this fake activity, all this misdirected money, it's all been funneled into one specific place. And that place has now become the absolute epicenter of this entire crisis, the housing market.
Now this slide here tells you everything you need to know about the scale of this thing. In the US, housing is a big deal, right? It's about 17% of our economy. Now look at China. It's a staggering 30%. I mean, when an industry gets that big, it stops being just an industry. It becomes the very foundation of the entire financial system.
So how did it get so massive? Well, that foundation was built on three huge drivers. First, you had pure speculation. People just buying up apartments expecting prices to go up forever. Second, there really weren't any other good places for people to put their money. The stock market is notoriously unreliable. And finally, you have something that's pretty unique to China: social coercion. This coercion is all driven by something called the hukou system. Basically, it ties your access to essential public services, like where your kids can go to school, to your official place of residency. So for millions of migrant workers, buying a wildly overpriced apartment isn't really a choice. It's often the only way to become an official resident and lock in a future for their family.
Now, a lot of people hear housing crisis and immediately think of the 2008 crash in the US. But this is a totally different beast. You see, the 2008 crisis was driven by household debt and inflation. China's crisis is one of deflation, and the debt isn't really held by individuals. It's held by provincial governments in these massive state-owned companies.
This brings us to a huge paradox. We know Beijing can basically print money at will. So why hasn't a massive wave of stimulus just fixed the problem? The reason is that China has already kept its foot slammed on the stimulus pedal for nearly 2 decades straight. It built so much, so fast, that it eventually just ran out of useful things to build. And that's how you end up with the infamous ghost cities, entire districts of empty apartment towers and roads that literally lead to nowhere.
And all of this was funded by debt. While the official numbers look manageable, once you add in all the hidden liabilities from local governments and state-owned enterprises, China's real debt-to-GDP ratio is estimated to be over 300%. Let me say that again, over 300%. You just don't see numbers like that outside of failed states.
So you have all this rot on the inside, and now it's being amplified by intense pressure from the outside, particularly from the United States. And that adds a whole new layer of complexity to this game.
You might have heard about a recent truce, but let's be clear, it was more of a temporary ceasefire than a real resolution. Those crippling 47% average tariffs on Chinese goods, they're still in place. And with all the major provisions expiring in late 2026, it's really just a one-year pause button on a much, much larger conflict.
But China is not just sitting back and taking it. No way. It's making some really strategic countermoves to insulate itself. It has cornered the market on critical minerals, it's building a non-Western economic bloc with partners like Russia and India, and it's rapidly creating alternative payment systems to bypass the US dollar.
So let's bring all these threads together. Where is all of this heading? Are we looking at a sudden collapse, or is it something else entirely?
Well, the key takeaway here seems to be this. A sudden, violent, Soviet-style crash is probably not on the cards. And the reason is simple. China is not a free market economy.
The leadership has too many levers of control they can pull. They are sitting on $3.4 trillion in foreign reserves. They can order state-owned banks to print money and bail out the system. And they have a clear win-win path, finishing the millions of homes people have already paid for. This prevents social unrest while directing stimulus toward genuine, actual demand.
So what all of this seems to point to is not a rapid collapse, but a long, slow, grinding decline. The system is over-leveraged and just doesn't seem able to transition to a more mature growth model. And that leaves us with the ultimate question. Is what we're witnessing a controlled demolition designed to reset the system? Or is it simply the beginning of a long and painful decline?